We gotta talk bears. Bear piece straight from T.S. Lombard on a potential profit collapse. Or is there? Or will we just get more rate cuts? Let's find out. All right, let's see. The best one can get out of the latest GDP numbers are indicators from last week, are indications for the quarter ahead and the upturn in non-financial profits. So outside banks, right? Profits outside banks. There is no ongoing profit squeeze to finally contract growth in Q3. Slowing, yes, but contraction, no. Okay, fine. Profits lead wages and hiring and precede capital spending. So in English, profits first, then you hire, then you invest. All this ties together to determine trend inflation. Real gross domestic income has been falling despite rising GDP because of profits, as corporate profits can go up without necessarily rising incomes yet. With this quarter's turnaround, gross domestic income rose 0.5% in Q2 after declining 3.3% in Q4 and 1.8% in Q1. Expect GDI to be adjusted upward in September. Bureau of Economic Analysis has reset its treatment of net interest, as much of the income should be more reliable in terms of an indicator of the economy. GDI is what typically ends up taking on the bulk of the adjustment. Okay, great. So what does all of this actually mean, and what does it matter? Well, here's this pretty neat chart. And it basically shows you this pretty strong correlation between hiring and margins. As margins go up, you tend to get more hiring. And as you get more hiring, the goal is hopefully margins continue to go up. And once margins begin to fall, hiring falls. And there could be a little bit of a mismatched lead and lag in this depending on when some of these things are reported. But intuitively, this makes sense. Companies make less money. They on gross profit, they end up hiring less. Great. So employment growth, excluding white collar, about to reverse. Now, I thought this was a very interesting title, because it really suggests that, look, we have had this nearly white-collar recession here, right? Blue being white-collar here, black being blue-collar, which is kind of ironic. You think they would have used blue for blue-collar. But anyway, you can see that blue-collar employment has been very, very strong. And this is one of the reasons some have actually called this recession or whatever we're in a rich session. In other words, the wealthier, richer people are getting screwed more. They're able to buy less Teslas. They're able to buy less Enphase solar panels. And they're basically getting screwed because, these finance jobs are getting laid off. Goldman Sachs is doing another round of layoffs. The banking crisis led to layoffs. What's fascinating, though, is this potential that we might be at an inflection point. We might have hit a bottom in the white-collar rich session, so to speak. This could, by the way, correlate, although we did have recent news with the Tesla Model 3 Highland release, it could potentially correlate with an increase that we're seeing in search trends for buy Tesla. I'm not a big fan of just searching for models when you look at Google Trends, and I don't mean like women models. I'm talking about like Tesla Model 3 search results. I'm a big fan of just searching things like buy Tesla or lease Tesla or cost to buy Tesla. And we are seeing an indication, as we talked about earlier, that we're trending back up above that 50% relative strength level. We usually don't stay above that for very long, but the longer we can stay above or near 50%, the better it ultimately is for Tesla sales. So really important. And it is possible that if you end up getting a recovery in white-collar employment, you could end up sooner rather than later ending up seeing these companies that originally, I personally thought as well that, this was, if we're going to have an inflation recession, it was solely going to be the poorer folks that ended up getting hurt. And what ended up happening was, yes, poorer folks got hurt by inflation. That was true. But the people who were really getting layoffs and a lack of pay raises were the finance folks or the white-collar people, the office workers, the HR workers. AI hit that sector as well, as opposed to the blue-collar. And so that ends up hitting stocks like Tesla and otherwise, right? Even honestly going down to PC demand, office equipment demand, office furniture demand, home furniture demand, restoration hardware demand, all this sort of stuff. Profit margins were never going to stay at 2021-22 levels, obviously. They reflected a transitory peak in demand and pricing power. This is very true. The inevitable deceleration slows wage growth and hiring. That's true, and that's what we're seeing now. At the same time, inflation from peak demand and peak COVID disruptions also unwinds for a longer term. Therein lies the magic formula of immaculate disinflation. Oh, I love it when they say that. T.S. Lombard's such a bear, but that's okay. Aided by tighter but not too tight monetary policy. Profit margins stabilizing in Q2 at still high levels tosses a monkey wrench into the idea of basically the Fed cutting. So here's T.S. Lombard coming out with their bear piece. They're saying, look, if you're getting stabilization in profit margins in Q2, then stabilizations in profit margins are going to lead to more hiring. More hiring is going to lead to the likelihood that you need to keep rates higher. That's that maybe one more rate hike that even Goolsby's talking about, who's pretty much a straight up dove, and ultimately staying higher for a longer level, right? So you get that extra rate hike, maybe we top out, but it just takes a lot longer to start getting cuts, and the cuts come slower than expected. Remember, there's this belief that the Fed might cut 25 BP at every meeting. They could also skip on the way down. You could go 25 BP, skip, 25 BP, skip, until, of course, something breaks. But anyway, this is a problem that T.S. Lombard argues, and it really echoes what Bank of America said this morning, which suggests that his stocks will probably be under pressure for a while. And the reason they'll be under pressure is mostly because you're in this phase of, okay, well, if we're going to be higher for longer, why don't we just stay in bonds or other investments or just money markets and just wait for maybe something to break and then go buy at that point. Money markets would be your best opportunity, by the way, in my opinion, not personalized financial advice, to be prepared for something breaking, because you're not exposed to the risk of your bonds losing value if you're in bonds, and you're not exposed to stocks losing value if you're in stocks. So anyway, okay, so T.S. Lombard goes in and says, I expect profit margins to contract in Q3. So this actually goes from the argument that, oh, well, things are going to be higher for longer because profit margins are higher, and now flipping into the idea of, oh, but wait, don't worry, the earnings recession is still coming. That Q3, Q4 timeframe, which is kind of what, you've had your Mike Wilson over at Morgan Stanley always complain about. It's coming. We're going to have more earnings crushes. And to this point, I expect profit margins to contract in Q3, given that Q over Q growth in final sales of domestic product has been dropping relative to the 90-day paper rates. Spreads have turned negative, a cautionary signal, and Q4 moving averages suggesting that the economy is basically about to slow. If, however, the relationship fails to hold in the current quarter, and we see that hiring data and basically improve, and the recession gets delayed even further, then guess what? More higher for longer. So you have this bearish argument here. And it's a very interesting bearish argument because it's kind of like the bears can't be wrong. Bears can't be wrong. That's basically what T.S. Lombard is arguing. I actually think the bears can be wrong. I'll tell you how. But and you should already know how. But the bears can't be wrong argument is either earnings recession and EPS pain / valuation contraction, right? Valuation contraction, multiple contraction, or you get recession, which basically just leads to EPS decline. Either way, you're screwed. So you have, well, I guess this could almost be one of the same, right? You could say you have an earnings recession and EPS pain, and or a recession causing that EPS pain. And then you could say that the second argument is or stronger, but then higher for longer and delayed EPS pain. That's basically what they're arguing, okay? This is how the bears say they can't be wrong. Now, one of the reasons that I argue that there's actually a good chance the bears could be wrong is because I believe that the market is mostly of this mindset of, okay, we need to get used to the idea that inflation could actually end up being transitory. Let's grab the bell quickly and explain this.
Supported podcast company. That's a nice entry into what Disney did yesterday. 7-handle, Jim, for the first time in several years.
Yeah, we had Michael Nathanson on this morning, really talking about the upper hand belongs to Charter. I don't know what to do if I got the Charter piece of paper just as, listen, Bob Iger, you have to give us Disney.
Anyway, perfect opportunity for me to mention that we are doing this. We're basically bundling together all of the courses, and we're going to raise the prices of all of the courses probably within the next week here. So stay tuned for more information on that. But basically, if you want to get into an individual course and you want the best price possible, now's the time to do it. You get lifetime access to the live streams. Get in before that changes because we've got some big announcements coming, and it's going to be a lot more expensive to get into the courses for the ones that we've got right now, which are really amazing. And the lifetime access to the live stream. So check those out, link down below. But let's go back to this this idea here, which is that my argument as to why, while the Bears argue they can't be wrong, one of the reasons you actually could be wrong is that as our country becomes more comfortable with this idea of inflation going away, you end up having what I've always called for this very sort of volatile Nike swoosh recovery. And this would be over years. And so far, that's exactly what's been happening. I expect that to somewhat continue. Okay, so let's see what else they say here. So they wrap up their piece by arguing the profit pickup in Q2 means the coming run of employment data has added importance, basically higher for longer. Okay. To be clear, there will be nothing in the August report that pushes the Fed to hike in September. But current employment trends, this is a way of saying, like, just because they're going to pause doesn't mean we're wrong. But current employment trends reflect profit losses pre-Q2, and inflation lags employment. If employment data trends reflect profit losses pre-Q2 and inflation lags employment. Okay. If employment data shows some undue strength, then rounding back to a turnaround in Q2 profits and uptick in hiring would be a strong signal that the Fed will raise rates. I lean towards recession sooner rather than later, based on the jump in real yields at the long end and the inventory cost of carry on top of everything else, including warnings to mid-sized banks to get their balance sheets in order. Blah, blah, blah. I feel like it's kind of like, I think EPS is going to decline, and here's the kitchen sink. It's kind of a little bit of what I feel like the T.S. Lombard argument here is on this recession coming. But they're not wrong, right? I mean, strength in GDP is going to keep rates higher for longer. The question is, how much does that actually matter? You look at the Atlanta Fed real GDP forecast, the GDP now they call it, and we're sitting at 5.6%, and that's pretty aggressive. We actually get our next update, let's see here, September 6th was the last one. It was just 2 days ago, so it's going to be another, okay, the next update is actually later today. Later today, we'll get the latest update on the Fed Now GDP update. What I think is neat about this chart is just how aggressive the Atlanta Fed Now real GDP chart is versus other measures. You look at the St. Louis real GDP measure, and it's much more in line with what we call the blue chip consensus, which is like the market consensus. You can see that right here. This blue line is the market thinking GDP is around 2%. And Atlanta thinking it's somewhere around 5.5%, which just seems a little wild. But anyway, yeah, it makes sense why there's this idea of higher for longer. But, and this is why I think the Nike swoosh continues to hold, you have to remember that if the economy and GDP are booming, but inflation continues to fall, then it doesn't matter. Remember, Jerome Powell did not say we are going to hike more if the economy is strong. He said we're going to hike more if the economy is strong and inflation is going up. That's the key, and I think a lot of bears are really forgetting that. And I feel bad for a lot of people who have been 100% on the sidelines and not at least having some exposure. And that's because they're constantly looking for this bear narrative without realizing that you're basically getting cooked to death like a frog in a lobster pot that you're turning onto a boil. It's like you're slowly getting unbared, but if you're not allocating, then you're getting burned.